Hey everyone, it is late and I've been doing a lot of thinking. I wanted to share some thoughts that have been weighing on me, thoughts about what is really happening in the financial world right now. It feels like the market is giving off a series of alarm bells, and yet no one seems to be paying attention. I used to think the market was always rational until I started seeing these discrepancies. And trust me, they are glaring. Let us look at what has been happening on May 13th. The US Treasury auctioned 30-year bonds at a yield higher than 5% for the first time since 2007. And just 6 days later, that yield climbed even higher. Bank of America's top strategist, a brilliant mind, calls a 5% yield the Maginot Line, named after that supposedly impenetrable wall France built to keep Germany from invading during World War II, and well, we all know how that worked out. Now, the financial version of that line has just been totally trounced, and BofA is saying the door to doom has opened. It sounds hyperbolic, I agree, but it is possibly all too accurate. The hits just keep on coming. Japan's 30-year bond also hit its highest yield in history. The UK's 30-year bond is at its highest since 1998, and Germany's 10-year bond is at a 15-year high. A bond blip in one country would not be the end of the world. I mean, we have seen those before, but this many blips happening everywhere, all at once. This is becoming very hard to ignore. Every previous time we have lived through a version of this story where one country is breaking, the others have been stable, so capital has always had somewhere safe to run, but not this time. And the stock market, the stock market, it has not priced in any of this distress. The SP, despite what is going on, just hit fresh record highs. The bond market is screaming, but the stock market is partying, and they cannot both be right. That is just mathematical certainty, not a guess. In 3 blunt and brutal parts, I am going to show you why the bond market is screaming, why the Fed is trapped, why the stock market is dangerously detached from reality, and what is likely to happen next. So, welcome to part 1. The economic Maginot Line was just breached between September of 2024 and December of 2025. The Federal Reserve cut interest rates 6 separate times. That is 175 basis points in total. And during that exact same window, the 30-year Treasury yield did the opposite of what it was supposed to do. It rose by nearly a full percentage point. This is where it gets interesting. In the previous 7 Fed cutting cycles going back to the 1980s. Long-term Treasury yields were lower 100% of the time within months of the first cut, not even most of the time, every single time. This is the first cycle in over 40 years where that pattern is broken. This is not just a blip. This is a fundamental shift, a broken pattern. The whole point of having a Fed in the first place is that they can manipulate the economy. There are massive downsides to having a Fed. We all know about the inflation and distortions it can cause, but at least they are supposed to be able to stabilize a fragile economy, like the one we are in now, to have a Fed with all of its inflation. But not be able to steer the economy when it gets into trouble like we are now is horrendous. It is like having a car with a broken steering wheel. It is still moving, but not in the direction you want. So when the Federal Reserve cuts rates, but the long-term borrowing does not get any cheaper, you have got a real problem. Cutting interest rates to lower the rate of borrowing is the entire mechanism that has defined how central banking has worked for the last century. If that mechanism is failing, then we are in uncharted territory. Let us look at how this all is supposed to work, because the inverse relationship between the price of a bond and its yield can confuse people. Many people may not understand what is happening right now. The price you can sell a bond at and the yields it delivers to the owner actually move in opposite directions. For simple math, just imagine the US government wants to raise some money. So they create an IOU known as a bond. They put it up for sale for $100 and agree to pay whoever owns it $5 of interest per year for lending them that money. That is the 5% yield. Pretty straightforward, right? But these bonds can be sold on a secondary market after the initial purchase if the original buyer does not want to keep owning the bond for whatever reason. If the demand for the bond is strong, buyers bid the price up, let's say to $125, and that same $5 payout from the government now works out to be just 4% based on the new purchase price. The yield goes down because the price went up, and if demand is weak and buyers will only pay, say, $80 for a bond that was originally purchased for $100, the yield jumps up to 6.25% based on that new buyer's purchase of $80. So when you see headlines about yield spiking, what those headlines actually mean is that if the US government wanted to issue new debt right now in this environment, they would be forced to increase the amount of interest that they pay to entice people to lend them money. That is what is happening right now, and it is not just happening in the US. The exact same pattern is playing out across nearly every other major central bank on Earth. The UK's 30-year gilt is at the highest yield since 1998. Japan's 30-year is at an all-time record going back to 1999. Germany's 10-year is at a 15-year high, and National Bank of Canada strategists just reported that average G7 yields collectively have hit a 17-year high at the end of April. Unfortunately, the strain is not just being felt by the US, it is rapidly becoming systemic. Now, obviously, I hope that the BOFA using the door to doom rhetoric ends up proving to be more clickbait than reality. But Bank of America's chief strategist is aggressively trying to get us all to look at three moments in modern history where, when bond yields ripped higher, they did so right before a major crash. You have Japan in 1980. Anine right before the Nikkei collapsed and started what became known as the Lost Decades, the US in 1999 right before the dot-com bust, and China in 2007 right before their market collapsed. Three crashes preceded by identical fingerprints in the bond market, and they are identical to what we are seeing right now. With the important caveat that historically, this does not play out across several systemically important economies at once. So not only are we seeing the fingerprints that have traditionally preceded a big crash, we are seeing it happening virtually everywhere at the same time. It is usually just one, and that leaves investors the ability to move somewhere else to stay safe. But where do you go when it is all happening at once? Now, the bad news is, while this is happening, the Fed is trapped, losing its ability to help steer the economy. Cutting interest rates right now will not pull the yields back down. It would actually make the problem worse, because bond buyers are already telling the market that they do not trust that they will get adequate long-term returns on their risk at the current rates and cheaper money. If they cut, just means even lower returns on the risk that they are taking. And that inflation would run even hotter if they did cut the rates. All of that would only serve to make already less attractive bonds even less attractive. So they are trapped. The question becomes, how did the Fed end up in this trap? Because it has a cause, and that cause is our second alarm bell. Welcome to part 2. The inflation trap. It is closing 2 months ago. Before the strike on Iran, U.S. inflation had actually eased all the way back down to 2.4%. The Fed was headed to easy street. Things were looking good, and the bond market was even starting to relax, but not anymore. On May 12th, the Bureau of Labor Statistics reported that the Consumer Price Index has already hit 3.8% year-over-year for April. That is the highest recording since May of 2023. So in just 2 months, inflation has jumped a full 1.4 percentage points. That is not a minor fluctuation, that is a significant surge. And to make matters worse, producers' prices, the increase in price that businesses experience, that caused them to raise prices for consumers, hit 6% year-over-year. That is the fastest increase since the end of 2022. Now, when PPI goes up, consumer prices are going to go up. It is a pretty direct correlation, so people should expect to be paying even higher prices in the next 3 to 6 months, meaning inflation is not done accelerating, which, by the way, will only serve to compound the bad news. Because for the first time in 3 years, the average American is now losing ground in real terms. Wages, adjusted for inflation, have turned negative. Workers take home pay, again adjusted for inflation, fell 0.3% over the last year and 0.5% in April alone. So, in addition to the fact that the bond market is insisting on higher rates because they are growing more concerned about the stability of the U.S. economy, the Fed cannot even cut rates to try and stimulate the economy because inflation has come roaring back, and it has already eclipsed wage growth. This is a vicious cycle. The cause is not exactly a mystery, though. Energy prices alone are up 17.9% year-over-year, whatever could be the cause. Gasoline is up 28.4%. Oil is sitting above $105 a barrel at the time of this recording, and the Strait of Hormuz, through which roughly 20% of the world's oil passes, is still not fully operational because of the war. This is like the 1979 Volcker problem all over again that caused all kinds of economic distress. This is oil-driven inflation that will permeate virtually every area of the economy, except this time the U.S. is sitting on top of a debt pile that makes Volcker's response, which was to jack up rates to 20%. It is totally impossible. Now there is no way you could do it given our debt. So, the Fed once again is locked. They are boxed all the way in. They cannot raise rates to try and kill the inflation because the interest payments on the national debt would break the Treasury, and they cannot cut rates to save the bond market because cutting rates with inflation reaccelerating would crush the dollar and make inflation even worse. They are in a trap. That is what I have been warning about for over a year, and the market is finally starting to wake up to it. Right now, Fed funds futures are pricing in a roughly 50% probability that the Fed's next move is a rate hike, not a rate cut. By December, that is a significant shift in expectation, but this is just part of the story. The inflation, the trapped Fed, the oil shock, the squeezed paychecks, all of that should be hammering stocks. They should be coming down, but they are reacting to none of it. They are pretending it is not happening. And that brings us to the loudest alarm bell of them all. Welcome to part 3. The stock market has become completely irrational. While the bond market is screaming bloody murder and signaling massive distress, the stock market is at a fresh all-time high. That is insane, because the math behind this rally has done genuinely stupid. We are pricing in an historic value explosion extraordinaire that would have to come so fast that it beats the bankruptcy that is looming in the background because of the massive infrastructure build-out that we are doing to get AI data centers up, and it looks less and less likely by the day that the revenue is going to hit before the bankruptcies. This is a race against time. A race that history suggests is rarely won. The Philadelphia Semiconductor Index, the SOX, is currently trading 62% above its 200-day moving average, to put that in plain English. Semiconductor stocks have rocketed so far above their average price over the last 10 months that the gap is now the widest it has ever been in the history of the index. This kind of deviation usually signifies extreme speculation. Additionally, the Shiller-Cape ratio just crossed 40. If you do not know this one, you are going to want to understand this. This is a glaring alarm. We have only ever crossed 40 to 1 in the Cape Index twice in the 150-year history of the market. Guess the dates: 1929. I hope that is a familiar date, and 1999, two of the biggest crashes we have ever seen. The first one ended in an 89% drawdown, and the Great Depression, the second, ended in a 78% NASDAQ collapse that saw an entire lost decade for equities. There is no third example with a happy ending because there is no third example at all until now. This is not a coincidence, this is a pattern of excess. What Cape at 40 actually means in plain terms: investors are paying $40 for every $1 of average inflation. Adjusted earnings the SP 500 has actually produced. These are actuals over the last decade. The long-run average is around 17. Every serious study of Cape as a forward indicator says the same thing. At these levels, the implied 10-year return for the SP is somewhere between 0 and negative. You are not being compensated to own stocks. Possibly, if these numbers hold, you are likely being charged to own them. You are likely to lose money. This is the boring truth, the math, not a speculative fantasy. Bank of America's chief strategist is not comparing this to the dot-com bubble anymore. He is comparing it to the Mississippi bubble of 1720. This was the speculative mania that ended up wiping out the entire French economy, but wait, it gets worse. The Magnificent Seven tech stocks now make up roughly 30% of the entire US stock market. The entire rally is balanced on the back of 7 companies. It is basically all just AI. All of the growth is not just riding on the back of a few companies. It is riding on the back of one single technological bet, a bet that is entirely dependent on the kind of staggering infrastructure build-out that has caused massive wipeouts historically. I am talking bankruptcies as far as the eye can see. It happened with the railroads in the UK, and again with the railroads in the US. It happened again with the telecoms when they built out the internet. When you have these massive infrastructure outlays that require massive growth in revenues to follow, if the revenue does not follow fast enough, it does not mean the technology is bad, but it does mean a lot of people are going to go bankrupt, and the next generation of owners are going to be the ones that reap the benefits.